Hi, my name is Harsh Gupta and welcome to the third webinar of our FutureBets web series. To all of you who attended our FutureBets unconference in Mumbai last year, um, you would know that we are very sad to cancel the physical event this year. However, for obvious reasons, however, in place of that, we are very excited to take it online, where you can listen in to some of the brightest minds from all over the world, from the comfort of your couch and in the comfort of your PJs. Case in point, our guest today is coming to you live from Singapore. I'll briefly introduce him to you in a moment. Also, please check out www.makefuturebets.com for upcoming webinars as well as a stellar speaker lineup. Before we start, I'd just like to take a minute to quickly introduce Ashika Group to you. Ashika Group is a 25-year-old diversified financial services group offering services such as brokerage, lending, investment and merchant banking, wealth management, and asset management. Our team of more than 300 work together to provide services to over 125,000 retail clients, 100 plus institutional clients, and 100 plus family offices. Now, I'll start the introduction of our guest today, who's very kindly given us our time, Dr. Anantha Nageswaran. He is an MBA from IIM Ahmedabad, and then went on to do his PhD in finance from University of Massachusetts. He worked with UBS and Credit Suisse in Switzerland and Singapore. Then he was the Chief Investment Officer for Julius Baer, the Global Chief Investment Officer for the bank. His last position was being the Dean of IFMR Graduate School of Business, which is also known as Kriya University. He is a member of the board of directors of many companies in India. In Singapore, he is a co-founder and member of the board of directors of NPS International School. Most importantly for today, he is currently a part-time member of the Economic Advisory Council of the Prime Minister of India. However, I must add that whatever he'll say today would be his personal opinion. He has also co-authored a book, Economics of Derivatives, as well as another book, Derivatives, published by Cambridge University Press. Just for information, one of the co-authors was me, myself, Harsh Gupta. And he has also written other publications for Carnegie and other think tanks such as Can India Grow in November of 2016. His last book is The Rise of Finance, Causes, Consequences and Cures, also published by Cambridge University Press. Before I hand it off to him, I'll briefly introduce myself. Once again, I'm Harsh Gupta. I'm the Chief Investment Officer of Ashika Group. I have an economics degree from Dartmouth College and an MBA from INSEAD. Besides co-authoring the book that I mentioned, I also write columns for Mint and other publications. So without any further delay, it's over to you, Dr. Anantha Nageswaran. Thank you so much once again for your time.
Thank you, Harsh. Good evening, good afternoon, depending on which part of the world you are in. And Harsh, thank you for clarifying that I'm indeed speaking in my personal capacity and not as a part-time member of the Economic Advisory Council to the Prime Minister of India. So in this presentation, I'm going to focus mostly on India today. And if there are questions about the global economy and currencies, etc., I'll be happy to take them later. So India, the COVID-19 impact and the post-lockdown response is my topic today. So first things to start off, I would like to make it a good news for you. If you look at the line, the green line in this chart, you can actually, I think I'm not yet shared the screen. Just give me a second. I'll just share my screen with you. So I presume you can see my screen now. So if you look at the slide here, the green line is India. So clearly the trajectory of the total number of fatalities in this country, no matter how tragic it is at the level of individuals and families, etc., and we must acknowledge that. The point remains that compared to other countries, India's trajectory has been very different and better. And that public health officials do tell me that India's latitude, the position where India is, has certainly an influence on the way the virus spreads. And therefore, the warm weather and humidity, which has been mentioned as potential differentiators, is indeed playing out. And you can see that even in other developing countries in Southeast Asia, etc. So even if the current death rate does indeed pick up, it would settle at somewhere around 5 per million population, which is much lower than what we have seen elsewhere. So that's the good news. And now we move on from the COVID impact to the impact on the economy. So the government has clearly taken some steps. Testing is accelerating, and the lockdown, even though it has been one of the most drastic ones in the world, has clearly played its part in keeping the infection rate down. If you look at this chart here, you can see that emerging markets have suffered quite a bit, much more than they have in previous currencies. The assets, emerging market assets, stock markets have taken a cliff dive, and capital has left emerging economies quite a bit. But are all emerging markets the same? I think India is somewhat different, and you can see here, it might be a bit tough to read, and I apologize to you for that. You can in fact look for it in newspaper articles. The McKinsey Global Institute has indeed come up with a research report, which has not yet been made public, looking at various scenarios in India. And what they see is that India will have a negative growth rate of around 2% in the course of financial year 2021. And the earlier scenario, which is slightly better, is a negative growth rate of 1.2%. And the third scenario, which is even more dramatic, and that would be quite a deeper economic contraction, which they don't specify. And right now, based on the surveys that they have done, they indeed are focusing on scenario number 2, which is about minus 2.5% in terms of the FY21 numbers. Real GDP contraction of minus 2.5% they see as the scenario here. And if you look at the second slide, they're also showing that this would require, to address this and keep this 2.5% negative growth or contraction up to that level and not worse than that, or even do slightly better than that, they suggest that India will have to undertake a fiscal support and stimulus measure of around 5% of GDP, around 10 lakh crores of rupees, because India's overall nominal GDP in Indian rupees is considered to be 200 lakh crores. So this would require support to the companies to maintain their workforce, reconstruction and infrastructure build out in the healthcare sector, provide bankruptcy protection and liquidity support to MSMEs, etc. And also slowly bring the economy out of the lockdown so that economic activity can come in. So this is their scenario, and you can look at the slide here. The orange line is the second scenario, which at the moment they think is the most likely scenario, which means the quarter ending June, according to them, the economy will see a 20% contraction before picking up and recovering and entering positive territory by the time we go into the last quarter of the fiscal year in January to March 21. But if you look at the third scenario, the economy doesn't enter into positive territory at all throughout this year. That's a very, very deep contraction, approximately close to 9% for the whole year itself. That will be one of the probably the deepest contraction the Indian economy has ever experienced post-independence. And also, if you look at the economic impact, agriculture workforce is 36% of GDP. My friend Neelkan Mishra of Credit Suisse tells me that in the pandemic of 2018, the Spanish flu, the agricultural sector was one of the sectors that did well, because by nature it doesn't have too much of congregation of people in one place, etc., allows for social distancing. So the fact that India has 36% of the workforce in the agricultural sector is actually a good thing at this point. And also, if you look at the fact that the current Rabi crop harvesting, at least anecdotally from whatever I have gathered from a few states, there isn't much of a shortage of workers except in select pockets. What we need to bear in mind is by the time we get into the sowing for the Kharif crop in June or July after the monsoon, then by then hopefully the social distancing measures are sufficiently relaxed that we could have a proper sowing of the Kharif crop. Otherwise, food inflation will be a factor going into the next financial year or the second half of the current financial year. And if you look at the sectors that are going to be affected, as everybody knows, sectors that depend on human movement and contact are going to be the worst hit. There isn't much of a insight into saying that. Airlines and hotels, automobiles, advanced industries, and then followed by construction, textiles, freight and logistics, which moves goods and services, etc. So clearly, if you go down the list, you have chemicals, IT-enabled services, which can let people work from home. Pharmaceuticals will actually benefit. Telecom and agriculture. Agriculture, as I mentioned to you, comes very last in terms of the impact from the virus. So the top ones are the most vulnerable ones in terms of the overall output contraction on a Q4 to Q4 basis, March to March, and also on a fiscal year basis. There is quite a big impact on airlines, autos, construction, textiles, etc. And if you look at the implication for workers, you look at the scenario 2. Construction will see a huge decline in workforce, followed by trade, hotels and restaurants, manufacturing, and then transportation. So clearly these sectors are the ones which would require support from the government in terms of allowing the establishments and enterprises to retain their workers by providing them credit facility to be able to meet their wages and salary payments and also the statutory payments. It is not enough to sort of warn the industry not to lay off workers in this situation, which can be very cruel on many families. But that said, since industries also are not receiving any income because not only domestically but also export orders have been cancelled, and whether it is SME or large enterprises, cash flow isn't there, and the only entity in the country that can generate autonomous cash flow is the state, the government, and the central bank. So we need to see before the April payroll date comes due, governments have to provide a credit facility for industries to be able to at least keep their workers on their payroll and continue to keep them warm so that when the economy resumes functioning, they can quickly ramp up production. So now, given this, if the Indian government does a fiscal stimulus of up to 5% of GDP, as McKinsey is recommending, is India in a position to do so? Because if you look at the last 5 to 6 weeks, major emerging economies that have undertaken stimulus have seen financial markets treat them very badly. Of course, you could say that is because investors were selling whatever they could sell, and there was some risk parity trades, etc. And countries, in fact, have been better than India with respect to fiscal deficit. Even then, they have suffered a market reaction. If you look at whether it is Philippines, Indonesia, South Africa, Brazil, Mexico, Turkey, etc., bond yields have gone up. Currencies have weakened when they announced fiscal stimulus and monetary policy interest rate reductions. India has done a modest fiscal support, and the central bank announced a fairly aggressive intervention on its part on March 26th. The difference between India and these countries are as follows. Many of these countries that have suffered in the hands of the financial markets, they are commodity exporting countries, or they are countries that are dependent on global trade. India probably belongs to the third category. It's an oil importer, current account deficit country in general, but this year India will have a current account surplus. And because it's an oil importer, it is benefiting from the sharp discount in the oil price, sharp drop in the oil price. And India does not have foreign ownership of its sovereign bonds to the extent that countries like Indonesia, Turkey, and Mexico or Brazil have. These are India's big differences. The drawback against that is that the Indian fiscal deficit is already at a very high level, and Indian financial sector is very fragile. So even as the central bank announces moratoriums on interest payments by companies, by individuals, etc., there has to be a watch on financial stability, especially after the S-Bank resolution happened in a particular manner, which did not engender confidence in other remaining private banks in the country. So more than the fiscal deficit, India's financial stability needs to be watched and proactively addressed. But looks like India can engage in incremental stimulus, if not to the extent decisions. First, they took care of the compliance restrictions, and second, the finance minister addressed the most vulnerable segments of the population, and the central bank came out with its own large support as well. And we are not done yet. The other countries which announced fiscal stimulus actually inflated their numbers to present the appearance of doing far more than what they actually did. If you look at the way Malaysia has done, only 20% of the announced amount is actually on budget stimulus. Or the same with the UK, where about half of the announced fiscal stimulus is on budget, the rest are guarantees and contingent or loan facilities given to establishments and households. So if you take into consideration what the Indian federal government has done, the state government has done, state governments have done, and the central bank, it will add up to a sizable fiscal support already. And therefore, and more is probably on its way, and therefore it is not correct to say India hasn't really done enough yet. And also, there is a feeling that if the lockdown were removed by middle of April, there won't be much of a stimulus that is required. That is not true, because the US intelligence report clearly says China has underreported infections and deaths, and therefore quite what it does to the infection fatality rate is anybody's guess if you get the full numbers, etc. And moreover, having forced people into a state of panic, governments world over will find it difficult to persuade them to get back into full swing, and the natural human tendency will be to remain risk averse for some more time. So there is a certain passage of time that will be required before economic activity will come back to full steam. And that's why even in scenario 2 that we saw earlier, the GDP growth comes into positive territory only in the 4th quarter of the current financial year. And secondly, even if you look at private equity and venture capital funds, they would take some time to start investing. And therefore, fiscal support will be required even if the lockdown were fully lifted either by mid-April or late April or mid-May, etc. Regardless of the manner in which the lockdown is lifted between mid-April and mid-May or end of May, I don't know the time frame here, I'm just guessing as most of us are doing. Even then, fiscal support to the economy will be required, not just to the most vulnerable segments of the population, but also to industry, small, medium, and large, so that the employment scenario doesn't deteriorate meaningfully. The other thing that one can predict will be happening in the Indian context will be that corporates will stop capex spending. They will have to generate cash flow first before they invest. And as we saw in the slide earlier, bank non-performing assets will indeed become a little bit worse. I don't know if they will go through the roof again, but they will definitely deteriorate, because India was beginning to come back and banks were reporting declining non-performing assets. That would now reverse, unfortunately. I think the savings rate will increase, but because of income growth under constraint, the extent of improvement in savings rate in the households will be felt only over time. So, but the net effect of all of this will be that capital formation, that is businesses investing in new production facilities, will not happen as much as India needed. If you remember, even before the virus struck, India's economy was only embarked on a very fragile and slow recovery that would unfortunately be pushed out even further. Of course, there is a lot of speculation on how the workplace will change in the future, and India will also witness some of it in the service industry for sure. But I think it's important that manufacturing, which requires physical presence, there is a greater amount of behavioral nudge that is given so that people are feeling comfortable and confident to step out of their homes and into factories and assembly lines. The automobile industry will definitely have a major structural shift, which is already under a big structural onslaught coming from e-vehicles and the new emission norms, etc. But clearly a lot is going to change in terms of mobility. And I think automobile industry is in for a big inflection world over, and India is no exception. Online education will pick up, no surprises there. I think, as I show later, healthcare industry is something that can actually not only boost India's GDP growth in the short run, but it can also act as a major preparation for future such episodes. Thankfully, hopefully we won't get them, but I think investing in healthcare, both services, pharmaceutical production, as well as the infrastructure, physical infrastructure in terms of hospitals, beds, and medical equipment, that could be both in economic stimulus activity as well as in terms of improving the health levels of the country, because among the India's Human Development Index, health parameters are rather on the weaker side, and that would actually boost productivity of the workforce down the road as well. So I would see this as a sector having a big multiplier effect, the healthcare sector and the infrastructure, health infrastructure. If you look at what is happening to the rest of the world, does India have an opportunity here? Yes, I think not only the focus should be on short-term support to the economy, but also on preparing India to take advantage of some of the geopolitical development that will be happening, because I think there is going to be a major aversion to China, because everybody knows that the virus outbreak was not communicated to the world for at least 4 to 6 weeks. And even as the travel bans were imposed in Wuhan, the Wuhan residents were allowed to leave the country and go out for the Chinese New Year break, and that is what spread the infection globally so rapidly, making this into one of the worst disasters for the world economy since World War II or the Great Depression. So clearly there is going to be a major loss of trust and credibility on the part of China, and what you see in this slide is that the European commissioner, foreign policy commissioner, has fired the bullets on the European side, and America clearly has been in the forefront, calling out China for its acts of omission and commission with respect to the virus and its spread in the whole world. So geopolitically, India will have an opportunity to position itself somewhat in a limited way for manufacturing, and more importantly, India can pursue a domestic manufacturing strategy, providing support to domestic industry without incurring the wrath of American regulators or trade representatives or WTO, because everybody is trying to reshore production of critical medical equipment, critical medicines, etc., and India can do the same. In fact, the FDA scrutiny of Indian generic drug manufacturers will come down after the virus settles. So these are all the pockets of advantages that India has. As I mentioned, Andy Mukherjee, writing for Bloomberg today, says that healthcare spending, because it is quite low in India, has a 1.17%, has a huge opportunity to ramp up here, supporting growth and supporting for people's health as well. And currently, India, despite the largely poor population, is forcing the public to use its own resources to spend a lot of money for healthcare. Many developed countries provide public support, public funding for healthcare spending, and therefore the stimulus, to the extent that a bulk of it is concentrated on the healthcare sector, it will serve multiple objectives. Coming back, we did present earlier the case for India to be able to do a better fiscal stimulus without incurring the financial markets wrath or financial market treating it harshly. One more such a favorite statistic is presented here. India's foreign exchange reserves as a percentage of the overall external financing needs, even in a stressful scenario, is India has a cover of more than 200%, 2 times. So in that sense, India will not necessarily see a very big depreciation of the Indian rupee should the government undertake a fiscal stimulus supported by Reserve Bank of India rather than Government of India borrowing the money from the bond market. I think the pressure on the Indian rupee will be far less because India has a huge foreign exchange reserves cushion, and even under a stressful scenario, it really constitutes 200% of India's external financing needs, and that's a very good thing. And this slide, you may not be able to see it, but it's available in the Moody's website, and I must say that Moody's has made most of its recent research reports publicly available. Global growth is going to be -2%. In fact, after I prepared this slide, I learned that JP Morgan has a global GDP growth forecast of -2.9%. Even in the 2008 recession, global growth did not turn negative. This time it's going to be negative, and the US will be very badly hit, 9% for the US economy, etc. So clearly, that's why I said this is such a big shock, and it is still unfolding, that the global attitudes towards China will undergo a meaningful change. And this slide, again borrowed from Moody's, presents the various sectors that will do well globally. The red color one will be very badly hit. The moderate exposure to the virus and the low exposure are basically construction materials, defense, pharmaceuticals, packaging, rentals, food and real estate, etc. And those are the sectors that we should quickly enable them to ramp up and come back by letting the workforce go into these sectors and start economic activity as well. Now, coming to the financial markets, as the last few remarks from my side. Globally, stocks have staged a short-term rally yesterday and in the US and today in Asian markets, etc. This is par for the course given the kind of corrections we saw, the sharpest and the fastest 20% decline, overall 30% plus in S&P 500. But in general, you should remember that despite the 10 years of the bull market we saw since 2009, stocks have done poorly compared to other asset classes on a 20-year time frame. They have badly beaten the inflation rate. If you look at NASDAQ 100, treasuries and gold have done very well. And given the kind of fiscal stimulus backed by central banks that developed countries have undertaken, and they don't have any ammunition to do monetary and fiscal stimulus now compared to 2008, but yet they're being forced to do so, clearly points to a potential realignment of global monetary regimes and also a potential inflationary outbreak down the road. And therefore, I would personally expect that precious metals will continue to do very well. And I think stocks in general will have a very tough time repeating the last 10 years in the next 10 years, because you could have a stagflationary scenario in the world economy like we experienced in the 1970s. And that's my comment on the stock market. Of course, we can also say that whether these governments have done the right thing in terms of locking down the country everywhere, not just in India, but everywhere. And that is a question that will be debated for years and years. There won't be a satisfactory answer because we cannot do counterfactual and controlled experiments here. But the reason why such a lockdown across the world has created a massive economic impact is because coming into the crisis, virus crisis, economies have been least prepared. Post-2009 recovery has been built on more debt. And that is why either the corporate sector or the real economy both of them have been left vulnerable for this kind of a shock. And central banks have also made investors become more complacent towards risks. And that is why there is such a major impact. And also clearly the panic reaction comes from the public, comes from social media, comes from epidemiologists, etc. And I think this wonderful article by a former Supreme Court judge in Sunday Times in the UK clearly says that humans have acquired an irrational horror of death. Death is a great obscenity, etc. And therefore, we are prepared to do whatever it takes to avoid even a single death. And this attitude, which does not accept the natural risks that are there in the system, in the economy, which our forefathers have faced very, very well, that we don't want any single death and we will do whatever it takes to avoid it, creates costs elsewhere in the society. And this is somewhat similar to how central bankers have said, we will not permit a single business cycle contraction on our watch. And that is what has made the global economies more vulnerable. We need to accept failures, we need to accept setbacks, and view that mentally, if we are prepared to accept them, we will be better prepared. In fact, yesterday we heard from Professor Ajit Mishra I had met him in February, of the Institute of Economic Growth in Delhi and Bath University. He suffered the COVID virus and he went through the hospitalization and came out fully recovered. He says media has overdone stories of how serious and life-threatening COVID-19 can be. It has drilled fear into the people unnecessarily as well. And I think from the government point of view, not only it is important to do the fiscal stimulus, we need to understand the behavioral damage that has been caused to the public psychology. Indians in general are extremely resilient, and we have a natural inbuilt fatalistic attitude to accept setbacks and move on. But yet, I think we have fallen into the trap that has been set by the Western mindset of panicking and mimicking their strategies at the social level as well. Therefore, we need to nudge that those who can afford consumption should be able to go for more of it while being sensitive to the poor and the low-income households. Lastly, I would say there is still a big contribution that India can make to the world as a result of COVID-19, and that is the namaste. Because that is the best form of greeting. Scientific research shows that a strong handshake transfers bacteria almost 200% relative to a moderate strength handshake. They favor a high five or a fist bump, etc. But even then, the best is namaste, and that should be India's big contribution to the world after the lockdowns are lifted and the world gets back into social mingling and interaction, which is the lifeline, the lifeblood of humans in general. We are social animals. We are going to interact, but we will start greeting people with a namaste. Thank you very much. The floor is yours.
Thank you so much, Anant. I think that was absolutely fascinating. You covered from the public health side to the economics and finance side. We have a lot of questions both on Zoom as well as on Twitter, and I have summarized them to a few categories. And I think we still have time we have about time for a few questions for sure. So the first question I'll mention is, what is trending on social media right now is maybe a partially distorted answer, but President Trump talked about retaliation if India would not release hydroxychloroquine, I managed to pronounce that properly, at the right time. And so what do you think about, if the US is clearly...
I would just quickly request Dr. Anant to stop his screen share so we can look at him.
Yeah, thank you. I have done that. Thank you for that reminder. And yeah, so I wouldn't read too much into his thread. We know the kind of communication style that he adopts, and I don't think India would also be impervious or indifferent to his request. It is a question of figuring out our needs and then making certain stocks available to the United States. So I don't think I would read too much into his tweets or warnings. That is his style of communication. So I wouldn't read too much into it.
So the next question is something you've already briefly covered. It's about the global currency system. You mentioned that, precious metals could do well if there's a lot of printing globally. At the same time, you have an excellent column today, along with co-authored about the US dollar remaining the reserve currency. So do you want to maybe explain the dynamics better about the global reserve currency going forward?
Your audio was not coming through fully clearly, Harsh. I missed the second part of the question.
The second part of the question is, do you just want to explain your take on the global reserve currency in these kind of two contradicting situations of printing too much, but the US being dominant?
So I think the US Central Bank, Federal Reserve, has clearly come up with a lot of measures, and the central bank balance sheet has expanded tremendously. And normally people would say under normal conditions, this should lead to a weakness in the dollar. But we also know that there's a global dollar shortage. The dollar liquidity is missing, and that is why the US Federal Reserve had announced repo for even emerging market central banks. So clearly, I think as we mentioned in the article today in Mint, I don't see the prospect of the US dollar immediately being replaced by any currency. Europe is in fact, even there are question marks about the Euro zone surviving this crisis with a lot of mutual recriminations going on between Italy, France, Netherlands, and Germany, etc. So I will not think that there is an imminent danger to the US dollar, but certainly if the economic stagnation continues for a decade, as I expect, I alluded to the return of the 70s, then by the end of the decade, we could see a certain call for a new monetary arrangement in the world, and that will still have a major role for the dollar to play. So right now, from an investing standpoint, I don't see any major currency realignment happening in the near future.
Thank you. It was an excellent column indeed, co-authored with T3 or Shri Thiruvadantantai. The next question is about how do you see the interest rates specifically within India going forward? The question is both about retail and corporate borrowing rates for the next 3 to 5 years.
Well, 3 to 5 years is too long a horizon at this stage when things are changing rapidly, almost on a daily or an intraday basis. I certainly do think that there is more room for interest rate reductions in India. I mentioned the possibility that if the sowing doesn't happen in June, July after the monsoon, then yes, you could have some food inflation issues, but that is again for the future, next financial year. So right now, inflation is relatively modest. There is a huge drop in the velocity of money circulation. India's M3 broad money growth is below the narrow money growth. So I think given all of that, there is room for central bank to cut interest rates. But whether it translates into lower long-term interest rates is also dependent on how well India controls the financial system and makes it more stable rather than less stable and somewhat worrisome for the investor's point of view. So while I'm confident about the short-term interest rates room to come down, the long-term interest rate will also depend on the kind of actions India takes on the financial stability front.
That's extremely useful. The next question is, do you think what can India do to better attract more patient capital for its various infrastructure and other financing needs? Are there any alternative structures or some ideas that you have?
I mean, in fact, I would say Harsh Gupta is the better person to answer for this question other than me. I think I would simply point out from a more macro perspective, and I think from a financial market perspective, this question should be posed to Harsh on his Twitter handle. He will answer it going forward. I think the ease of doing business relaxation that India has been pursuing should happen at the state level as well. And there are still important restrictions on land use conversion from agri to non-agri uses. The floor space index is still very low in many Indian states. Stamp duties, these are all, and I think, yes, we can also bring down the overall GST rate structure going forward, but all these things have to first wait for the immediate fiscal support and fiscal stimulus. These actions will not only help domestic investment to recover, but also will attract foreign capital. And by the way, India hasn't done badly at all with respect to attracting foreign capital in recent years. We should mention that here.
Anand, that's excellent. I think there's an excellent question which has come up. A couple of people have asked it in different ways. So what about fiscal deficits after this black swan year? So how do we think of fiscal deficits, a roadmap? What about FRBM? What about the fiscal council recommended by Rajan, Patel and Acharya? Or do you support some other version of it?
Well, I think the paradigm in the world itself is going to undergo a big change with respect to fiscal deficit. I think, we had a 40-year spell of it's an almost dogmatic approach to fiscal policy, to inflation targeting, and then trade policy, etc. And all those things are going to undergo very big changes. So the way society is going to evolve post-COVID and will definitely have an impact on economic discourse, and what is considered normal, what is considered excessive, etc. will definitely be redefined. And India, I think, for the next 2 years at least, must suspend the FRBM. And yes, from the Indian standpoint, because we are starting with a fairly high fiscal deficit already compared to other countries, for our own reasons, because the more the government borrows, the less money is available to domestic private sector, or India will have to depend more on foreign savings. That is just national income identity. So to that extent, I think India on its own, regardless of the global discourse, must keep an eye on the medium-term fiscal deficit and the debt trajectory. We should not lose sight of the medium-term fiscal prudence. And in the short term also, nobody is advocating that India does the kind of stimulus that UK or Germany or other developed countries are able to adopt, because we don't have the kind of hard currency that they have, and that's unfortunate. Market does discriminate somewhat unfairly between developed and emerging economies. That's the reality we have to face. And therefore, I would say, yes, India, to the extent it can, must relax fiscal policy, must suspend the FRBM rules in the near term, maybe 1 to 2 years. But from a 3 to 5 year perspective, India must resume the work of signaling to the world that it does take fiscal consolidation seriously for its own good, even though the global narrative, I think, will change.
There are a lot of questions about people concerned about small and medium businesses. I know you already covered that in the presentation, but is there any specific point that you would want to emphasize?
I think from what I gather, even in my conversations with some of them, since I'm very closely involved with many SMEs, both because friends are running it, and because in some cases I myself have been invested in them in the past, etc. So I have sort of taken an interest in seeing how they are doing. And what I gather here is that I think they feel that they can handle the private sector contractual rearrangements, whether it is rents or governments have given some moratoriums on tax payments, etc. But it is clearly they need, and all of us know that the biggest chunk of any operating cost of an enterprise is the labor cost, and that is where they need support urgently, and also working capital facility, because many retailers have cancelled orders and the companies have already spent money in producing the goods and putting them on transit. So a working capital package and employment preservation package both have to be designed and put in place very, very quickly. And after that, depending on how situation evolves, further support can be thought of. But these are priorities in my view.
There's another very interesting question that always comes up on Twitter is whenever somebody talks about gold and currencies, what is your view on cryptocurrencies going forward?
I personally don't see them as alternative stores of value. They are alternative means of speculation.
Okay, that's a very clear answer. A lot of people are asking, how are we, some people are saying 500 rupees or 1,000 rupees to a farmer or a widow is not enough. Like the transfers, like are you in support of some form of UBI, I suppose? All these things, UBI, MMT, which used to be like buzzwords, are suddenly becoming partial realities. So MMT, I think we've kind of discussed indirectly. What would you say about UBI?
No, I think the word universal, the English meaning is it's universal, without discrimination. And I don't think India can have a universal basic income in that sense, for the entire 135 crores. But clearly there is certain criteria, income thresholds, etc. And given technology and given the kind of data we have, we can really target it. So it's basically basic income transfer for targeted segments of the population. I think that is definitely necessary in the short run for a year or two, as many other countries have done. So it is purely from an English sense, it's not correct to call it universal. So it is targeted income transfer. Maybe it is TIT.
I think that makes a lot of sense. I think the only thing is we perhaps need to have a better database going forward.
Yeah.
I think we have time for a couple more questions. One question is, again, a lot of questions about trade. In the new world post-COVID, how does India have an export strategy when everybody is going to protectionism, and what does that mean for Indian growth?
No, I think probably the question itself has its own answer. There is going to be a lot of reshoring, and there is going to be more domestic factors of production, even in developed world, more emphasis on domestic production. So I don't think reviving exports is going to be an urgent priority as much as reviving, producing healthcare for your own population, reviving construction sector, etc., transport, logistics within the country. Those things become urgent priorities than export strategy going forward. So it's a question of relative emphasis. I think for export or the global trade to pick up to the levels we saw before the COVID struck is going to be a tall order. And even then, already we knew that there were lots of difficulties because of the US-China trade war, etc. So I think export strategy has to be selective and targeted, because we are not going back to the pre-2019 or even, and let alone pre-2008 world when it comes to export. So India needs to concentrate on domestic manufacturing. So this is a good opportunity to actually focus on Make in India for India.
Excellent. Now, this is the second last question. This question has also been asked by people in different ways. So we are right now all talking on Zoom, and we've heard news about, perhaps some of the information going to Facebook, some going to Chinese servers, perhaps. At the same time, there have been some reports that the defense minister used Zoom on Twitter. I don't know whether it's true or not. Yeah. So now that the digital world has gotten accelerated because of COVID, everybody's trying to work from home and so on and so forth. How does India approach this digital divide? Do we become a have? Do we become a have not? What kind of industrial trade policy do you think we should think about on this?
I mean, it's an excellent question, and I wish I have the answer to all those questions. But certainly, I would say India is better placed than other countries, given the kind of talent we have and the startups we have in the digital space. And also, government public-private partnership in India works far better than elsewhere. Whether it is the Bharat payment network or India's many other digital transaction companies, etc. India has a head start, and I would say therefore the digital mode of commuting, telecommuting, or workplace, the people working from home, etc. In all these aspects, I think India can actually take a lead both in terms of creating new products and creating new approaches. But what kind of policy? Yes, of course, we can talk about tax holidays or clear regulatory sandboxes kind of approaches, etc. We pilot many things, etc. So all those things are going to happen, and I think that is one of the areas, apart from the healthcare that I alluded to, where I think India could actually find another engine of growth. But I am not in a position to answer specific strategies or tactics that the government should be adopting, and I'm sure a lot of midnight oil is being spent on coming up with those.
No, that is absolutely true. The India stack is there, and we just need to make sure we leverage it in a nice PPP.
I was looking for the word India stack. It didn't come to my mind. Thanks, Harsh. Yeah.
Absolutely. So the last question, again, very broad and open-ended, but we always end with this question. So Dr. Nageswaran, what is your future bet that you would like to talk about? The future bet that you are most excited about?
Talking about the financial markets, or?
Unfortunately, there are a lot of greedy people right now in this podcast.
Ever since Chairman Alan Greenspan reduced the federal funds rate to 1% in 2003, I have been very loyal towards yellow metal as my important bet in my personal portfolio, and I would definitely like to mention that it is an insurance and not an investment.
That's an excellent point to the people who are listening to this podcast who perhaps may not know. Dr. Nageswaran's personal financial blog is known as the gold standard. So there might be a hint there of what he believes to be his future bet. Thank you so much for your time. I think it was an excellent and very educative session. I'm sure there are some unanswered questions even now. We'll probably try to share them with you, and maybe some answers can be shared on social media. But thank you once again, Dr. Nageswaran, for your time.
You're welcome, and all the best to all of you. Stay safe and stay healthy and stay cheerful.
Thank you.